Hello, everybody. At this time, we are talking about managerial economics. Managerial economics is a field of study that integrates economic principles with managerial decision making processes. It serves as a bridge between economics and business management, offering insights and tools to help managers make informed choices in the face of scarce resources and dynamic market conditions. Essentially, it applies economic theories and methodologies to analyze and solve real world business problems. In the realm of managerial economics, decision makers assess the costs and benefits of alternative strategies, examine market trends, and consider the impact of various factors on business outcomes. By blending economic theories with practical business scenarios, managerial economics equips managers with the ability to optimize decision making, maximize efficiency, and achieve organizational goals in a constantly evolving business environment. And then we move to concepts of managerial economics. The first concept, supply and demand analysis. Understanding the forces of supply and demand is necessary for businesses to determine optimal production levels and pricing strategies. And then second, risk analysis. Business decisions involve inherent risks and uncertainties. Managerial economics equips managers with tools to assess risks, make informed judgments, and develop contingency plans. Third, cost analysis. Cost analysis helps managers assess production costs, identify cost drivers, and make informed decisions about resource allocation. And then fourth, market structures. Understanding different market structures such as perfect competition, monopolistic competitions, oligopoly, etc. enables managers to navigate the competitive landscape effectively. And fifth, pricing strategies. Setting the right price is a critical decision for business. Managerial economics helps determine optimal pricing strategies by considering costs, competitions, and consumer behavior. And then we move to importance of managerial economics. Managerial economics is essential for bridging the gap between theoretical economic concepts and practical business applications. It equips managers with analytical tools and frameworks to make sound decisions, optimize operations, and improve the financial health of the organization. By leveraging economic principles, managerial economics enhances the ability of managers to navigate complex business environments, respond to market changes, and achieve sustainable growth. In summary, managerial economics is a vital discipline that integrates economic theory with business practice, enabling managers to make informed decisions, optimize resources, and enhance organizational performance. And then we move to types of managerial economics. There are three main types of managerial economics. The first type, liberal managerialism. This perspective believes managers can make choices that benefit their company. It is based on the idea that the market will regulate itself and that managers can take risks and be innovative. And then second, radical managerialism. This viewpoint questions the existing norms. It suggests that managers should use their influence to build a fair and sustainable society. It stresses the importance of considering the needs of all stakeholders, not just shareholders. And then third, normative managerialism. This approach is more realistic. It recognizes that managers have limitations such as regulations and competition. They also have to consider stakeholders' interests. Managers use decision making guidelines to make better choices within set boundaries. And then we move to principles of managerial economics. The first principle, decision support. Managerial economics serves as a guide for decision making in various aspects of business, such as production, pricing, resource allocation, and investment. By applying economic principles to real world scenarios, managers can make informed choices that optimize the use of resources and contribute to organizational objectives. And then, second, policy formulation. Managerial economics contributes to the formulation of organizational policies by providing insights into the economic implication of different policy choices. This includes policies related to pricing, production, investment, and market expansion. And then third, resource allocation. Managers often face the challenge of allocating scarce resources such as labor, capital, and time to different activities within the organization. Managerial economics helps in evaluating trade-offs and making decisions that maximize the efficiency and productivity of these resources. And then fourth, risk management. Businesses operate in environments characterized by uncertainty and risk. Managerial economics aids managers in assessing and managing risk by incorporating risk analysis and decision making under uncertainty into the decision making process. And then fifth, profit maximization. One of the central goals of managerial economics is to assist managers in maximizing profits. This involves analyzing costs, pricing strategies, and market conditions to identify the optimal combination of factors that lead to increased profitability. And then we move to the scope of managerial economics. The first about decision making. Managerial economics focuses on providing tools and techniques for effective decision making by managers. It involves analyzing alternatives and choosing the best course of action to achieve organizational objectives. And then the second, government regulations and policies. Managerial economics considers the impact of government regulations and policies on business operations. Managers need to understand and adapt to changes in the regulatory environment. And then third, resource allocation. The discipline helps in allocating sources such as capital, labor, and raw materials optimally to maximize productivity and profits. I think it is enough. Thanks for watching.